My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to save you some money. My job is not just to entertain, but to explain. Tell you how days like today could happen. So call me, 1-800-743-CNBC, or tweet me at Jim Cramer. When interest rates spike, they can stop any rally in its tracks, which is exactly what happened today. After 8 straight days where the S&P 500 roared higher, we got a bond market-inspired pullback. In other words, rates went up big. The Dow losing 220 points, S&P falling 0.81%, and the Nasdaq tumbling 0.94%. And I don't think the market's done going down for now. If the S&P had gone up today, do you know that this would have marked the longest winning streak in 19 years? And it sure looked like we had it in the bag right up until we got a 30-year Treasury auction that no one seemed to be paying attention, but it had very weak demand. And that sent long-term interest rates soaring. As is so often the case, when these Treasury auctions fail and rates go up, stocks just get clubbed. It is ineluctable. Remember when the market caught fire last week? I told you it was all about the new Treasury issuance schedule for 2024. That was skewed toward the shorter end of the yield curve, mostly 3 to 10-year paper. Very few 30-year bonds would be used to refinance the debt. It was great news because the excess supply of long-term treasuries is what kept sending rates up. But all the Treasury issuance schedule didn't eliminate the 30-year auctions remaining for this year. And today, one of those auctions ended up pushing the yield on 30-year shockingly higher. It was dispiriting. But unfortunately, when the Treasury Department arranged the schedule for 2023, it emphasized that longer duration paper. It ended up doing gratuitous damage to everything financial.
The House of Pain.
Then right on top of the crummy auction, Fed Chief Jay Powell came out and said he may not be done. You know, he keeps playing that game. Nothing new here. He's been saying that he'll keep tightening if necessary for ages. Doesn't matter. No market's equipped to handle that devastating 1-2 punch, the auction and the Fed chief. So the averages, then they got pulverized. Stocks as an asset class cannot rally when interest rates spike, and the Fed says we still need to be vigilant against inflation. If rates keep climbing, I suspect the mortgage rates will be impacted immediately, perhaps by 1/4 of a point, maybe more. That's not what we want to see. The housing stocks were actually going higher recently. I mentioned this because today, in a really terrific CNBC virtual event, it's called Your Money, I got just an amazing question from my great friend Tyler Matheson, who pondered how this could be such a huge year, especially for the Nasdaq, given that interest rates have moved up so dramatically. Why hasn't that crushed the market the way that higher rates kiboshed this impossible bullish winning streak today? I mentioned immediately that, believe it or not, in the 1990s, we had several runs like this, and while some ended badly, others demonstrated that stocks can indeed resist the gravitational pull of the bond market for long streaks at a time. In short, it's unusual for stocks to go up in this kind of environment, but it's not unprecedented. So what does that mean for the nascent but powerful 8-day rally that seemed to be nipped in the bud today? Is it gone? No, I don't think so. I don't think the rally's over. But you have to understand that today was the kind of day we've seen many times, at least until 10 days ago. I think we have a few more sessions like this, but that doesn't mean they're going away entirely. And it certainly doesn't mean we are finished with the sell-off, because we got some negative reports tonight, which tell me that tomorrow it could be soggy. So you need to pick stocks very carefully right now if you're trying to make money in a market like this one after that great streak and us being now overbought. First, I would say, as always, there are some stocks that are, I don't want to say immune, but somewhat immune to the pull of bonds because they're not outrageously expensive and they represent companies that don't need to raise capital. In the 90s, it was Intel and Microsoft as the two combined to create the PC revolution. They were the essence of what worked in the 90s when we had higher rates just like today. This time, I'm thinking that 6 members of the Magnificent Seven remind me of Intel and Microsoft in the 90s. Currently, of course, Microsoft is one of them. The stock's zooming because they're actually making money in artificial intelligence. No, it's not hype with them. It's not hope. It's money. Actual products like Copilot that allow you to harness the power of AI yourself. At the same time, NVIDIA is the king of artificial intelligence chips. Amazon's been using AI for years. That's how they know what you'll buy. That's called inference, all right? Inference is key to artificial intelligence. The others aren't necessarily part of the AI mob, but most of them have some involvement, and they've got a lot of things going for them. Meta and Alphabet are taking a huge amount of ad dollars away from traditional media channels, more every day, and AI helps them make those ads more targeted. Look out, though, for these 2 of the 7 tomorrow, because a very sharp outfit called Trade Desk that I like very much reported tonight, and it is being crushed. It helps advertisers on the web get the best price and placements. It did see a real slowing in ads this quarter and gave a terrible forecast, okay? And that's something we didn't hear from Alphabet or Meta when they reported recently, but something that you're going to have to hear over and over again tomorrow, particularly when they start talking about it. Apple's really not an AI play, but its products and services are so special that it can withstand and has withstood the pernicious undertow from the bond market when it's been ugly. It's no coincidence that of the Magnificent Seven, only Tesla stocks be getting crushed because only Tesla's hostage to the bond market. They're an automaker, which means their customers need financing. When auto loans get more expensive, they lose business. More on the sorry state of EV affairs later in the show, but this is not a Tesla moment. The message. Companies can defeat the downward pull of interest rates if they have a fabulous secular growth story like artificial intelligence or superior technology when it comes to reaching people like Facebook and Alphabet. Again, though, remember, TTD is going to hurt those stocks tomorrow. We'll talk about them tomorrow at the 9. We'll talk about it at the club. Normally, I'd tell you that drug stocks with terrific stories can buck the trend, but the designated winner in Big Pharma, Eli Lilly, had run up so much that it was subject to intense profit taking today, down 4.5%. The rest of the group was weak, too, but not as weak as Lilly. Remember, most Big Pharma names are dividend stocks that compete directly with bonds. So when Treasury prices come down and rates go higher, the drug stocks, they almost always get hit. Didn't matter that last night Lilly just got FDA approval to use this revolutionary diabetes drug for weight loss. No, didn't matter one bit. By the way, the rest of the group, led down by Merck and Bristol Myers, demonstrated the bond linkage in a perfect way. Hey, by the way, I would buy Eli Lilly on weakness now that its miracle obesity drug can actually be prescribed for weight loss. In fact, you know, the American Heart Association is considering endorsing this whole class of drugs to prevent heart disease, and we could get something like that announced this very weekend when the AHA meets. Finally, there are the turnaround stories that are powerful enough that they won't be weighed down by bonds, at least the moment they're announced. Last night, we got tremendous news from Disney. Oh, my, it's about time. CEO Bob Iger laid out a plan to save $7.5 billion. That was up from $5.5 billion previously. Meanwhile, the company added about 7 million core subscribers to Disney+. That was much more than expected, and predicted the service would reach profitability by this time next year. That's on target. This is all good news. And it's coupled with the possibility, get this, that there'll be a dividend declaration very soon, and then maybe even, because they do have a lot of cash and a very good balance sheet, a buyback. Stock shot up almost 7% on that news. Yes, Disney's balance sheet is that strong, even after it buys the rest of Hulu from Comcast, parent company's network. Given the stock has been horrendous for so long, it was able to erupt higher today. You know what? That one's got more room to run. If that one comes down tomorrow, you know what can I say? Buy, buy, buy! Throughout the 90s, we saw amazing reinventions and cost cuts that took stocks much higher even when rates were on the rise. That could be Disney. Yep, innovation and self-help are what allow stocks to buck the pull of the bond market, just like we saw in the 90s. I think we actually could have one more up day. We would have, I think, if it weren't for Jay Powell's comments. But you know what? We're going to have to go down a little bit now because of what he said. Bottom line, remember the names that were doing well up until Powell delivered the coup de grace. Even the ones that did well this very morning, because those will be the first to bounce back when the smoke clears. And after a few days, it will clear. Jim in New Jersey. Jim.
Yes, sir.
Hey, Jim.
How are
It's
you?
Jim. I'm fine.
Yes.
What's up?
I'm calling in today from the great state of New Jersey with a question about Dominion Energy, stock symbol D. I bought it in the year 2020 at 81. Today it closed just below 45. It currently pays a respectable dividend of 2.67%. Considering where I own it, in your analysis, in the near to midterm, is this stock for me a buy, sell, or hold?
Okay, so Jimmy, listen to me. This stock is one of the worst in the utility segment. And the utility stocks are all down like the bond market has been down and interest rates go higher. So it's traveled with them. That's why it's down about 27%. They are doing a reorganization that sounds intriguing to me, and I don't want you to just ditch it right here. But it yields 5.9%. When it gets down to a 5% yield, in other words, when the stock goes higher, I do think you should sell it. It's just not that great a company. It's not. It used to be. Bud in Ohio. Bud.
Booyah, Ski Daddy. This is
Booyah,
longtime fan and very happy club member Bud calling from beautiful Akron, Ohio.
Oh, man, thank you so much. Thank you. I appreciate it.
Oh, thank you. Hey, listen, I've read all your books and would really appreciate if you could grade me on a very brief recap of my homework assignment on Huntington Bancorp.
Okay, look, Huntington Bank. I'm sorry, go ahead. I'm sorry, I didn't mean to interrupt. Go ahead. Oh, okay. Darn. All right, so listen, this is the problem. And And I said this today in this excellent meeting that we had with Tyler Matheson, this terrific. We do have some great programs around here, and it was your money, and it was so good. And here's what I was asked about. What regional banks, and I talked about Huntington, and it's incredibly well run. Steven Steinauer runs it. He does a great job. It yields 6%. They're doing a good job. But these are stocks that are out of favor with the market, and as long as interest rates are going to be work their way higher or stay this high, Huntington Bancshares is not going to be able to rally from these levels. It needs lower rates. That must happen. There's your homework, Rick. Can I speak to Malinsky in Virginia? Malinsky.
Hey, Cramer, thanks for taking the call. I appreciate it.
Of course.
Hey,
what's happening?
Do you know why 9 and 6 are my two favorite numbers?
No, what would that be?
Because at 9, I've got you on Squawk on the Street, and with you, Faber, and Carl, it's the best team of financial journalism going today, period. And then, of course, I've got Mad Money.
You're very kind. I thought you were like I thought you were like O's the mentalist. I was thinking other numbers that you were going to pull out of your head, but that's terrific. I like this. I like that. 9 and 6. Remember that over there. Yeah, the birthday guy is there.
And between the two, I can read all about the club, which I'm a member of. So cool.
Thank you. And we got a big meeting next week, and we got and don't fret about these the magnificent 6 of 7 that we have because I think they're doing well. Go ahead.
Hey, so I'm a little perplexed. Every restaurant I go to is packed, crowded,
right.
Anywhere I go. You know, and I travel around and any city. But still, the number one food distributor in the country can't get out of its own way. It's doing nothing. And I'm not talking about Cisco Networking. I'm talking about Cisco Foods.
No, you're absolutely right. It should be doing better. I don't know why it's not doing better. I know they have some higher costs. I know that they've been infected. You know, they've had the same affliction that all of us have with inflation. But you're right. It should be doing better because restaurants are doing better. We know the numbers. We know them from all sorts of different companies. I'm surprised that Cisco is not doing better than it is right now. A bad bond auction. When I say bad, I mean... Sell. And stern words from Jay Powell, 1-2 punch. We're too much to overcome this afternoon, but keep an eye on the stocks that were outperforming in the morning, because those will be the first to bounce back once the dust settles. And yes, Alphabet and Meta will be under pressure because of trade desk. We'll deal with it tomorrow, as that gentleman just said, Malinsky at the 9 o'clock. On Mad Money tonight. Thought it was game over for gamers? Grand Theft Automaker Take-Two Interactive got an extra life after its stock scored big this year. It's up 40% year to date. I'll see if the move can continue when I sit down with the CEO. Hey, if that stock comes down tomorrow, that could be interesting. Then, as the electric vehicle market short-circuiting, as growth in the space slows, I'll reveal how you should approach your investments in the major automakers that have spent years pumping cash in the business. I don't know if it's paying off. And from trains to planes to automobiles, ITT helps make the technology that keeps it all under control. I'm sitting down with the CEO, fresh off earnings, to find out what's ahead. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.